Welcome back to the deep dive. Today we're cracking open a big one. We're looking deep inside PepsiCo Inc., ticker PEP.
Yeah, everyone knows the name, knows the products, right?
Yeah.
Pepsi, Lay's, Gatorade. It's everywhere.
Exactly. But we're going beyond just the soda and chips today. We want to analyze how this, what is it, $194 billion giant is actually managing its huge portfolio.
That's the mission. Forget the juggles for a minute. We've got a stack of pretty detailed investment analysis here. Our job is to pull out the really crucial bits.
Right. How are they handling all the pressures, changing tastes, competition? There's a big strategic shift happening.
And how they defend what makes them unique, their competitive advantage, their moat, as analysts call it. We need to understand that.
It really is a classic situation, isn't it? A massive established company needing to change with the times. Consumers want different things now.
They do.
Yep.
And PepsiCo has to pivot, but without, messing up its financial performance or upsetting shareholders who rely on it.
So our goal for you listening is to get you totally up to speed, not just on where things stand now, but the big strategic questions, the risks, and also this huge global opportunity they keep talking about.
And it all really starts with this core idea, this kind of tension inside the company. They call it the dual engine.
Snacks and beverages together.
Exactly. It's their biggest strength, this synergy. But it also creates some interesting challenges, especially when you look at where the profits actually come from. We really need to unpack how that works.
Okay, let's get into the nuts and bolts then. Incorporated way back, 1919 in Delaware. And it grew into this behemoth based on a pretty simple idea, right?
Yeah, the core idea is complementarity.
Yep.
You buy snacks, maybe you want a drink. You buy a drink, maybe you want some chips. It sounds simple, but building a global business around it is complex.
And to understand it now, we need to look at how they're structured today. They actually realigned things recently. Q1 2025. 7 segments now.
That's right. They basically split the world into North America, which is their mature home base, and then the rest of the world, the international piece.
So North America has 3 parts. You've got Frito-Lay North America, FLNA. That's the snack powerhouse Lay's, Doritos, Cheetos.
The king of savory snacks, no question.
Then Quaker Foods North America, QFNA. That's like oatmeal, rice-a-roni, pasta. A bit smaller, maybe slower growth.
Generally, yeah. Solid brands, but not the growth engine Frito-Lay is.
And the third one is PepsiCo Beverages North America, PBNA. All the drinks for the U.S. and Canada. Pepsi, Gatorade, Tropicana, Aquafina.
Right. And then the other 4 segments carve up the rest of the globe. Latin America, Europe, AMESA, which is Africa, Middle East, South Asia, and APAC, Asia Pacific, Australia, New Zealand, China.
Okay, so that's the map. But you mentioned the profit picture is key. Where's the money really being made?
This is where it gets really interesting and, frankly, a bit unbalanced. Looking at the 2024 numbers, the snack division, just FLNA in North America, is just dominant.
How dominant?
Hugely dominant. Frito-Lay North America generated 43% of the company's entire division operating profit last year. Think about that. One division, one region, almost half the profit.
Wow. Okay, so compare that to the drink side in North America, PBNA.
PBNA. Only 15% of the total division operating profit.
15 versus 43. So snacks are basically 3 times more profitable operationally in their main market.
Exactly. And that tells you a lot about PepsiCo's strategy. The snack division, FLNA, is the cash cow. It's stable, high margin, generates the bulk of the operating cash.
So the beverage side.
The beverage side is crucial for scale, for making them essential to retailers. You need drinks. But strategically, it often functions as, well, maybe not a loss leader, but certainly a lower margin necessity that helps sell the high margin snacks.
You have to wonder how much patience investors have with those lower beverage margins sometimes.
Well, the synergy argument usually wins. Plus, those lower margins reflect the brutal competition. The cola wars never really end, and it's just more expensive, more capital intensive to run the bottling plants and the whole drink distribution system compared to snacks.
Okay, so strong North American snacks. But this leads to what the analysis calls the global scale paradox. Explain that.
It's a fascinating statistic. Roughly 60% of PepsiCo's business today comes from places where only 5% of the world's population lives.
60% of revenue from 5% of people.
Yeah. Think U.S., Canada, Western Europe, mature markets. Growth is slow, it's tough. It often relies on just raising prices because people aren't necessarily buying more.
Which means the opposite must be true.
Exactly. 95% of the global population lives in markets, India, China, Southeast Asia, Africa, Latin America, that currently only generate about 40% of PepsiCo's revenue.
That's the growth story right there, isn't it? A massive runway for international expansion.
Huge. And you can see it happening already. Q2 2025 numbers. International business grew 6% organically. Good momentum. But North America. Management said, and I quote, challenging consumer dynamics. Volume is basically flat or down.
So the plan seems clear. Use the profits from North American snacks to fund the push into that 95% of the world where they're still relatively small.
And that need to capture the 95% plus deal with the slowdown in North America is exactly why they launched this big strategic overhaul. The CEO, Ramon Laguarta, calls it winning with PEP Plus, or just PEP Plus.
Right, PEP Plus, it's their multi-year plan to make the company. What was the tagline? Faster, stronger, and better. Okay, let's break those down. What does faster actually mean for a company this big?
Faster is really about growth acceleration. It means getting much closer to the consumer, using data better, speeding up innovation, making marketing sharper, basically react faster to what people actually want.
Give me an example. How does a giant like PepsiCo get fast? It seems like turning a battleship.
It is like turning a battleship, but they're trying. So think shorter R&D cycles. Instead of spending years developing a global product, maybe they do more limited time offers, LTOs, or regional flavors based on, social media trends or local tastes.
Like those wild Lay's flavors you see sometimes?
Exactly. Or quickly launching new functional drinks. It's about being nimble, capturing niche trends before they go mainstream, especially internationally.
Okay, that makes sense. Pillar 2, stronger. Sounds like cost-cutting and efficiency.
That's a big part of it. Transforming capabilities, using technology, digitizing everything from supply chain to sales, and really trying to operate as one PepsiCo.
One PepsiCo. They weren't doing that before.
Well, historically, the different divisions could be quite siloed. Stronger means leveraging their massive global scale for things like buying raw materials cheaper, but then executing plans with local precision. They call it localization.
Localization, right. And technology is key there.
Yeah.
You mentioned partnerships with AWS, Salesforce. Is this where AI comes in to optimize their delivery routes?
Absolutely. They're using AI and data analytics for everything, optimizing truck routes, predicting exactly how many bags of Doritos a specific store needs, tailoring promotions based on real-time sales. It's about squeezing out every bit of efficiency. Stronger is about saving money to fund the faster growth stuff.
Okay, faster, stronger, now better. Sustainability.
Yeah.
A lot of investors see this as just PR, corporate fluff, but the analysis argues it's core risk management. How so?
Because the risks are very real and potentially very expensive. Better is about de-risking the business from major long-term threats. Take the positive choices, part reformulating products, less sugar, less salt, less fat.
Why is that risk management?
Well, think about it. We saw that stat, 66% of Americans trying to cut sugar. That's a direct threat to their core sodas and snacks. By reformulating, they reduce the risk of people just stop buying their stuff.
And regulatory risk too, right? Like sugar taxes.
Exactly. If governments slap taxes on sugary drinks or fatty snacks, products that have already been reformulated might be exempt or taxed less. That protects their profits. It's proactive defense.
Makes sense. What about the other parts? Positive agriculture, positive value chain.
Same logic. Positive agriculture, things like regenerative farming, helps secure their supply of raw materials like potatoes and corn, especially with climate change making harvests less predictable. Positive value chain aiming for net zero emissions, using less water tackles, resource scarcity risks, and potential carbon taxes. It's all about building resilience into the business model.
And this whole PEP Plus strategy, it's not just talk. The numbers show it's working.
Well, the track record so far is pretty strong, considering the chaos of the last few years. Between fiscal 2019 and 2024, so through the pandemic and high inflation, net revenue grew 37%, and their core earnings per share went up 48%. That shows they can execute even when things get tough.
Okay, so that's the strategy. Let's look at the playground they're operating in. It's huge, right? Beverages and snacks globally.
Massive, about $1.3 trillion. It's mature overall, so growth isn't explosive everywhere, but it's profitable. And there are definitely hotspots. Non-alcoholic drinks are forecast to grow over 6% a year, driven by things like energy drinks, functional beverages, bottled water.
And the competition is fierce. We have to talk about the cola wars.
The eternal battle. In beverages, it's still largely a duopoly with Coca-Cola. And globally, Coke is still the bigger player, maybe around 50% market share versus PepsiCo's roughly 20%.
What the big difference?
Different models, partly. Coke is mostly asset light, selling concentrate to bottlers. PepsiCo owns more of its bottling and distribution, which is more capital intensive. But PepsiCo's done well in supermarkets, the take-home channel, and especially with Pepsi Zero Sugar. That's been a real bright spot.
But there was a worrying sign in the sources about the main Pepsi brand itself in the U.S.
Yeah, that was notable. Recent reports suggest the core, full-sugar Pepsi Cola is actually losing market share in the U.S. It apparently even slipped behind Dr. Pepper.
Behind Dr. Pepper. Wow. What does that tell us?
It tells us the decline in traditional sugary sodas is real and accelerating. Dr. Pepper has this unique flavor profile, loyal following. It seems to be holding on to those legacy soda drinkers better than Pepsi right now. Just underlines why PepsiCo has to push so hard on zero sugar, energy drinks, water. The future isn't in the classic cola category.
Okay, so that's beverages. What about snacks? Total different story.
Complete flip side. Frito-Lay North America is just dominant, commanding market leadership in savory snacks. Think about potato chips, an $8.6 billion category. They own it.
Yeah.
Their main global rival is Mondelez, but Mondelez is more focused on biscuits like Oreos and chocolate like Cadbury.
So it's this weird imbalance. Struggling legacy drinks, dominant snacks.
That's the core dynamic. Now, how do they defend that snack dominance and try to shore up the drink side? That comes down to their competitive advantages, their moats.
Okay, beyond the obvious ones like brand recognition, everyone knows Lay's and Gatorade, and just their sheer size, what are the operational moats?
There are two really powerful ones. The first is their direct store delivery system, the DSD, especially for Frito-Lay.
DSD. Explain what that actually means on the ground.
It means PepsiCo employees in PepsiCo trucks deliver the snacks directly to the retailer supermarkets, convenience stores, you name it. And crucially, they stock the shelves, not the store's employees.
That sounds expensive. Hiring all those people, running all those trucks, why do it?
Control. Absolute control. First, freshness critical for snacks. Second, execution. The Frito-Lay rep walks in, sees what's selling, sees the empty space, and puts the right product in the right place. Builds the promotional display perfectly.
Whereas competitors who just deliver to the warehouse.
They're relying on the busy supermarket staff to eventually get their product from the back room onto the shelf, maybe position it right, maybe not. DSD gives PepsiCo a massive edge in how their products look and are available in the store second by second. It's a logistical weapon.
Okay, DSD is one moat. What's the other big one?
The synergy moat. This goes back to the dual engine. Because they sell both the leading snacks and top-tier beverages, they become incredibly important to retailers.
Ah, the one-stop shop idea.
Exactly. Think about a retailer, maybe a big supermarket chain or a gas station owner. They need chips and they need sodas and water. PepsiCo walks in and can supply high-demand products in both categories.
So when they negotiate shelf space or promotions,
They have way more leverage than a company that only sells snacks like Mondelez or only sells drinks like Coke in many situations. They can negotiate for the prime spots in the chip aisle and the best placement in the coolers, maybe tie them together with promotions, buy Doritos, get a deal on Mountain Dew.
right, bundling.
That cross-category power gives them huge bargaining strength and makes it really hard for smaller competitors to get good visibility. It's a very powerful advantage.
Okay, so powerful moats, but we know they're facing headwinds, especially in North America. Management keeps talking about subdued consumer dynamics, volume pressure. People are buying less stuff because prices went up.
Yeah, inflation forced them to raise prices pretty aggressively, and now they're seeing the pushback on volume, and that led to some interesting numbers in their Q2 2025 results.
How so?
Well, on the surface, net revenue and their core earnings per share actually beat expectations. So
Right.
the pricing held, the business looked resilient. But the official reported earnings, the GAAP EPS, dropped dramatically, like from $2.23 down to 92 tariff per share.
Big drop. Why? What happened?
A huge non-cash impairment charge, $1.86 billion. Basically an accounting write-down related to some intangible assets.
Okay, translate intangible asset impairment for us. What does that signal?
It signals management is getting realistic, maybe even conservative. They're looking at certain assets on their books, maybe older brand names, maybe some bottling assets, things like that, and saying, you know what, given where consumer tastes are going, we don't think this asset is going to generate the cash flow we previously thought. So they write down its value on the balance sheet.
So it's kind of an admission that some older parts of the business aren't worth as much anymore.
Pretty much. It doesn't affect their cash right now, but it suggests they're facing reality about the decline of some legacy areas and focusing investment elsewhere. It clears the decks a bit.
And that elsewhere seems to be buying growth. We've seen a lot of M&A recently.
Exactly. If you can't grow organically fast enough, you buy it. Look at 2025. They bought Poppy.
The prebiotic soda company that's been blowing up.
Right. Instant credibility in the gut health functional beverage space. And they bought Siet Foods.
Grain-free chips, tortillas.
Hmm.
The better-for-you Mexican-American food brand.
Again, hitting that health and wellness trend, plus the demand for cleaner labels, grain-free options. These aren't random buys. They're plugging specific strategic gaps where consumer demand is booming.
It feels like they're acknowledging they can't just reformulate Pepsi fast enough, so they need to acquire these cool, fast-growing brands.
That seems to be the strategy. Use the cash flow from the legacy giants, like Lay's, to buy into these hot adjacent categories where they lack a strong presence. Poppy is a perfect example. It immediately strengthens that struggling PB&A beverage portfolio.
And then there's the Celsius deal. That's a partnership, not an acquisition, right?
Right. Celsius Holdings, the big energy drink player. PepsiCo strengthened their long-term strategic partnership. Here, PepsiCo is using its muscle, that DSD distribution network we talked about, to get Celsius into more stores, more coolers, everywhere.
So PepsiCo gets a cut of Celsius's growth.
They get a significant revenue share, plus it gives them a much stronger position in the energy drink market, which is huge and dominated by others like Red Bull and Monster. Celsius gets access to PepsiCo's incredible distribution machine. It's mutually beneficial and maybe lower risk for PepsiCo than buying Celsius outright right now.
Okay, so lots of strategic moves, but this is all happening with a new player involved. Elliott Investment Management showed up in September 2025, an activist investor.
Yep. And Elliott isn't just any activist. They're one of the biggest and most influential. Their arrival definitely turns up the heat on management.
What are they asking for? Just financial engineering or more fundamental changes?
Their public statement called for greater focus, improved operations, strategic reinvestment, and enhanced accountability. It sounds operational, not just financial.
Greater focus. Does that mean they might push for breaking up the company? Spinning off the beverages, maybe?
That's the perennial question activists raise with PepsiCo. Should they separate the high-margin snacks from the lower-margin, capital-heavy beverages, or even the smaller Quaker Oats business? The argument is that might unlock value by letting investors value the pure-play snack business more highly.
Like a Frito-Lay standalone company.
Potentially. Whether management actually does that is another story. They've always defended the synergy model. But having Elliott breathing down their neck absolutely forces them to accelerate everything. Cost cuts, efficiency gains, making sure those acquisitions like Poppy integrate well and deliver results faster. The pressure is definitely on.
Okay, let's pivot to the core financials. Setting aside the recent impairment, how does the company look from a stability perspective?
Fundamentally, it's still a high-quality, defensive consumer staples company. Profitability is strong. Their trailing 12-month operating margin is around 15.1%. Return on invested capital, ROIC, is a healthy 13.1%. Those are good numbers in this industry, showing they run things efficiently.
But there was a flag raised about cash flow.
Yeah, that's the area to watch closely. While profits look okay, actual cash generation has slowed down recently. Net cash from operating activities was down 7% in fiscal 2024, and that trend apparently continued into the first half of 2025.
Why is operating cash flow slowing if profits are holding up?
The reports mention changes in working capital.
Okay, explain working capital simply. What does that mean for PepsiCo?
Working capital is basically the cash tied up in the day-to-day running of the business. Think inventory bags of chips sitting in warehouses and receivables. Money retailers owe them for products already delivered. If operating cash flow drops because of working capital, it usually means either inventory is building up, stuff isn't selling as fast, or retailers are taking longer to pay them, or both.
So the efficiency of turning sales into actual cash in the bank is getting worse.
That seems to be the issue. It's not a crisis yet, but a sustained slowdown in cash conversion would be a problem. Because that free cash flow is what pays for everything else. The dividends, the share buybacks, buying companies like Poppy, and crucially, the constant investment needed to maintain that expensive DSD network.
Got it. What about the balance sheet, debt levels?
They definitely use debt to boost returns. The debt-to-equity ratio is up there, around 2.79x. That's quite leveraged.
Is that risky?
It reflects their strategy. Their liquidity is also tight. The current ratio is below 1 at 0.78. That means short-term assets don't fully cover short-term liabilities. But for a company like PepsiCo that sells products so quickly, that's actually pretty typical. It shows efficiency, but it also means there isn't a huge safety cushion if something goes wrong unexpectedly.
Okay, let's talk about how they use the cash they do generate. Capital allocation. The dividend is key here, right?
Absolutely central to their identity for many investors. PepsiCo is a dividend aristocrat. That's a big deal. It means they've increased their dividend payout every single year for over 25 years.
And they just hit 53 years.
53 consecutive annual increases. It's an elite club. For 2025, they plan to return $8.6 billion to shareholders, and the vast majority of that, $7.6 billion, is going to dividends. Only $1 billion for share repurchases.
That's a huge commitment to the dividend, but doesn't that tie their hands a bit? What's the payout ratio?
That's the constraint. The dividend payout ratio, the percentage of earnings paid out as dividends, is high. It's around 76.7% based on trailing earnings.
3/4 of profits go straight back out as dividends.
Roughly, yeah. And that high payout ratio is the financial tightrope they walk. It leaves less money for paying down debt, less flexibility for really big, splashy acquisitions, or even accelerating investment in the business if needed.
But they are still investing, right? Capital expenditures, CapEx.
Oh, yeah, they have to. CapEx is still significant. It averaged about 45% of their operating cash flow over the last 3 years. That money goes into maintaining and upgrading factories, keeping the DSD truck fleet modern, and building out all that digital infrastructure for the stronger pillar.
So they're juggling. Keep the dividend aristocrat status, satisfy those income investors, but also find enough cash to fund this massive transformation and keep the core business running.
It's a very delicate balancing act.
Okay, so given that balancing act and the activist pressure, where is future growth supposed to come from? What's the bull case?
Number 1, 2, and 3 is probably international expansion. That 95% of the world's population generating only 40% of revenue. That's the single biggest opportunity.
And the international business is already showing good growth.
It is a 10% compound annual growth rate in core operating profit over the last 5 years. That proves the potential is real. But success there depends heavily on that glocalization idea we mentioned.
Meaning adapting everything to local tastes.
Totally. You can't just sell American Lay's flavors in India or China and expect massive success. You need magic masala flavor in India, maybe cucumber flavor in China. It requires deep local understanding, local sourcing, local manufacturing. It's complex, but that's where the volume growth is.
Okay, international is key. What else?
Product innovation, specifically focused on health and wellness and functional products. This is about offsetting the decline of the legacy stuff.
Like the Gatorade powders. The Poppy acquisition fits here too.
Exactly. Powders are higher margin, easier to ship internationally. Poppy hits gut health. They're launching new protein drinks. It's all about capturing consumers who want more than just taste. They want hydration, energy, protein, gut health, functional benefits.
And the third growth driver?
Digital transformation. Using AI and data analytics, partnering with AWS and Salesforce. It's partly about cutting costs, stronger, but those savings are meant to be reinvested into growth faster. Better data also helps them innovate faster because they understand consumer behavior better. It connects everything.
All right, those are the opportunities. But what are the big clouds on the horizon? The major risks?
The biggest, most fundamental risk is that secular consumers shift away from their traditional core products. That's 66% of Americans cutting sugar. That trend isn't going away. It's a direct threat to classic Pepsi and indulgent Frito-Lay snacks. They are literally racing to build up the better-for-you side fast enough to replace potential lost sales on the legacy side.
And on top of that demand shift, you've got regulatory risks.
Always. The threat of new sugar taxes, maybe stricter regulations on plastic packaging. These things can pop up anywhere in the world and directly increase their costs or impact demand.
Plus operational risks, like supply chain problems or if they raise prices too much.
Yes, supply chains are still complex globally. And there's always demand elasticity. If they push prices too high to combat inflation, consumers might just switch to cheaper store brands. They have to be careful with pricing.
Okay, so opportunities, risks. How is the market valuing all this? What does the stock valuation look like?
It's interesting. If you look at the standard price to earnings ratio, the PE, it's trading around 25.8x. That's pretty much right in line with its own 10-year average. So on an earnings basis, it looks fairly valued for a stable, high-quality company.
But there's another metric that tells a different story.
Right. If you look at EBITDA, the enterprise value to earnings before interest, taxes, depreciation, and amortization, it's actually trading near a 5-year low, around 13.9x.
Why the difference?
And why is the EBITDA low if PE is average?
If EBITDA includes debt in the valuation, and it looks at earnings before some non-cash charges. It's often seen as a better measure of underlying operational value, especially for companies with debt or significant physical assets. The fact that this multiple is low suggests the market is worried. Worried about what specifically?
Probably pricing in the risks we just talked about, the slowing North American growth, the execution risk of the big transformation, and maybe the high capital intensity of the business, especially that DSD network.
Ah, so the cost of that DSD moat shows up in the valuation here.
Exactly. PepsiCo consistently trades at a discount on EBITDA compared to Coca-Cola, which is asset light, and often compared to Mondelez, too. It's not necessarily saying PepsiCo is lower quality, but it reflects the fact that owning and operating all those trucks, warehouses, and bottling plants requires a ton of capital, which weighs on that specific valuation multiple. Coke outsources a lot of that. PepsiCo pays for control with capital intensity.
But despite that valuation nuance, the dividend yield is attractive.
Very attractive right now, relatively speaking. At around 4.0%, it's historically high for PepsiCo and looks good compared to many peers and the broader market. For investors focused on income and stability, that yield is a big draw, even with all the transformation complexities going on underneath. Hashtag outro, synthesis, and provocative thought.
Okay, quite a journey there. We've gone from the core dual-engine model, powered by those dominant snacks,
Protected by the DSD system and that synergy moat.
through this huge, necessary, expensive PEP plus transformation.
All happening under the shadow of shifting consumer tastes and now an activist investor pushing for faster results.
It really highlights a company with incredible strengths and resilience, but facing some very real, very significant challenges. That move away from the traditional core is a huge deal.
Absolutely. And the synthesis, the key takeaway, might be this concept of the strategic trilemma. Management has to constantly balance three competing demands.
Which are?
1. Defend the core, protect that North American profit engine, especially Frito-Lay. 2. Pivot to growth, aggressively buy or build relevance in healthier functional categories like the Poppy deal shows. 3. Expand globally, capture that massive 95% population opportunity internationally.
Doing all three at once requires flawless execution and a lot of capital.
Immense capital.
Yeah.
And that brings us right back to that financial tightrope, that central contradiction we discussed.
The activist, Elliot, wants focus, reinvestment, better operations, implying maybe more spending on transformation or M&A.
Right, but the company's capital allocation is heavily skewed towards maintaining that dividend aristocrat status, paying out over 76% of earnings as dividends, $7.6 billion this year alone.
So here's the final thought, the question for you, the listener, to mull over. Given how urgent this transformation feels, given how expensive it is to buy growth like Poppy and Siet, and given the constant need to reinvest in that DSD network, will PepsiCo's deep commitment to its current very high dividend payout become a major financial constraint? Could it force management into a tough choice between funding the future growth the activist wants and keeping those legacy income-focused shareholders happy with their ever-increasing dividend?
That choice, or how they manage to avoid making it, could really define PepsiCo's success or struggles over the coming years. It's the central tension to watch.
A fascinating dilemma indeed. Thanks for joining us for this deep dive. We'll catch you on the next one.